Welcome to Wall Street Training's module on the overview of the financial markets. In this module, we will quickly go through the specific industry jargon and go through exactly what is the sell side, the buy side, what is exactly investment banking, asset management, sales and trading, as well as hedge funds. Now look at the sell side and talk about the sales and trading, the exact flip opposite of investment banking. Sales and trading. What exactly is sales and trading? Sales is obviously a sales-oriented job in which they sell brokerage services and earn commissions on trades. These are the guys who are on the phones. They are compensated largely by commissions that are determined by the volume. So their job of the sales guy, their job is to get volume, get trades, so that the traders can now execute these trades. Traders and trading, generally speaking, facilitate the buying and selling of securities, stocks, bonds, currencies, commodities, derivatives, etc. The profits are largely determined by spread, the pricing, not necessarily the volume. Think about that for a second. The sales guy is responsible for primarily bringing in the trades from the client to say, hey, trade with us. They are compensated based on the amount of volume that they bring in. The traders, on the other hand, are not compensated necessarily on the volume, but how well and how profitable their actual trade is. So you have a fundamental disconnect here. What's the fundamental disconnect? The sales guy, they just care about bringing the volume. They don't really care about the profitability of the trade as much, whereas the traders care about the profitability of the trade. You might have all this volume, but at the end of the day, if I can't make a successful bid on it, or if I can't make a successful spread on it, I'm not going to make any money. So the sales guy don't care about the pricing as much. They just want to get the volume in. So again, sales and trading, while they go hand in hand, they're also flip opposites of the same coin. Now, keeping this in mind, the investment bank operates in what we call the primary market. The primary market is direct issues to the end investors from the issuer. Whereas the sales and traders operate in the secondary market, in which they maintain the active market in the primary issues. In other words, once these stocks and bonds have been issued by the investment bank, the sales and trader now actively make that market. What does that exactly mean? First of all, let's take a look at sales. You have several types of brokers. You have the retail brokers, is what we call our mom and pop John Doe. This, you might walk into any retail branch of a financial services institution, HSBC, Citigroup, etc. These are your traditional stockbrokers selling stocks and advice to individuals. Then you have the private client broker, in which you have, this is a stockbroker to high net worth individuals. Private wealth management or asset management might be considered even ultra high net worth, as well as small institutions as well. So this is private client brokers are considered smaller. Private wealth management deals with larger pool of assets. Then you have your institutional sales brokers, primarily selling to large institutional investors. These are the different types of sales and brokers. Traders. Again, traders primarily provide liquidity. They make the market, which means that they buy and sell on behalf of clients as well as the firm themselves. Their job is, again, to provide liquidity. So if the market is not able to fulfill the buy or sell order, the market maker has to. In addition, there are proprietary traders which take positions purely on behalf of the firm for profit. This is for the specific firm's profits. Real quick on terminology, the trading desk works on the trading floor of a firm, whereas floor trading is considered working on the actual physical exchange. For instance, the New York Stock Exchange. Sales and trading combined, again, sales provides clients and relationships for the traders, and the trader's job is to execute the actual trade. Broker-dealers are a term that is commonly heard but misunderstood. What is a broker? A broker is an intermediary who acts as an agent for one or both parties to a transaction. They do not commit capital. They receive a percentage commission for their services. Now, a dealer is the exact same thing as a broker, except what the dealer does is they do commit capital and they trade as a principal instead of merely as an agent or representative. And they typically only take one side of the transaction. Therefore, they earn spread or the profit on the difference. They do not earn a percentage commission. Effectively, when you hear the term broker-dealer, you can think of it again as an intermediary who does not take capital and does not commit capital, who earns commission, or a dealer who does commit capital and who doesn't earn commission but now earns an actual profit on the spread, the buy and ask. They are the ones who are trying to make the market as well. So the broker-dealer, in that sense, is also very similar to each other, a term that is commonly used together. Prime brokerage, on the other hand, is specifically brokerage services provided to hedge funds, pensions, endowments, and other institutional investors, and even other broker-dealers. So prime broker simply means, no, not prime rib. It's not necessarily the cut of the meat, but again, the prime broker specifically is providing brokerage services. Again, brokerage services, not to individuals, but rather to other institutions. And of course, here the volume does matter a lot. Check mark there. Volume does matter a lot, and broker-dealers are heavily regulated by the SEC.